Thank you, John, for your time to take this interview. When are you expecting the first cut of the Fed?
Our forecast has been a cut at the March FOMC meeting, which is quite soon. And it's really because of the decline in inflation combined with the guidance that we've gotten from Fed officials. But ultimately, this is going to depend on the data, of course. I think there are some upside risks and there are some downside risks to the inflation outlook. On the upside, we do have a lot of geopolitical uncertainty, especially in the Middle East. So that could certainly delay a first cut. But I think there are also some downside risks, and I would point to the impact of housing in the US inflation data, and also the fact that there are still some prices that are at very elevated levels that are probably going to decline in outright terms. Used cars, for example, and other consumer durables, and I think that's going to weigh on the inflation data as well.
Regarding trade and investment, what's the cost of the economy if the fragmentation of the world deepens?
If one economy has a comparative advantage in producing, say, manufactured goods, another economy has an advantage in producing, say, tourism services or intellectual services, then trading with one another can make both sides better off. That's the fundamental insight of economists such as David Ricardo 200 years ago, and I think it remains as potent as it's ever been. And it is certainly something that if you walk around the Congress Center here in Davos and you talk to economists, you're going to find a lot of support for that idea. Now, putting that into practice, of course, is quite difficult because there are always going to be interest groups. Domestic producers often have an incentive to restrict trade because they fear the foreign competition. And I think the role of economists and maybe policymakers more broadly is to encourage taking a broader view and looking at the benefit to an economy as a whole, not just benefit to individual actors in that economy.
Maybe that's not the job of the economists like you. It's the job of the policymakers.
Very much so.
Very much so. So the question is, what should they do?
Well, I think being in constant dialogue is an important prerequisite for putting in place cooperative policies. But my main recommendation would be to really focus on the idea that the world is not zero-sum. My gain is not automatically going to be your loss. Your gain is not automatically going to be my loss, but we can interact economically in ways that make both of us better off.
Let's talk something about China. We just got the 2023 results of Chinese GDP growth. So a general feeling about that?
Well, it was broadly as expected. We had been looking for a little over 5% growth for 2023 as a whole. We ended up with 5.2%. That was, pretty close, a touch below our most recent estimate, but generally in line with expectations.
What's your outlook in 2024?
So we have 4.8% for our 2024 forecast. So our expectation is policymakers will continue to stimulate at the margin with, some rate cuts in the policy rate. We have a cut in the reserve requirement ratio. We're expecting somewhat more supportive fiscal policies. I think we've seen some of this already over the last several months, and both in terms of steps that have been taken, incremental steps, but steps that have been taken, and in terms of what policymakers have said.
You said the word incremental, so that's why the Chinese investors are very impatient. They are expecting some more support.
I think we will see an impact of the measures that have been taken in that. I think growth is going to be a little bit stronger than what maybe other forecasters have in their numbers. I also think that there is a reluctance to be too aggressive in expanding credit because policymakers are concerned about the longer term imbalances that could be created that way.
Our premier said here that China will not seek short-term growth while accumulating long-term risks.
I think as far as the property market is concerned, it's the right thing to be concerned about, because I do worry about declines in property market activity over the medium term. We have seen declines in activity, and I think we will probably continue to see soft property market numbers. So I get the dilemma. I understand the dilemma. I think the best thing to do is to find ways of stimulating activity that don't work through the property market, and developing social safety nets that encourage households to spend a larger share of their income, for example, because they don't have to be too concerned about how they're going to care for themselves in old age, or maybe they're more confident about their ability to pay for healthcare bills. Those are things that I think are more sort of clearer avenues for supporting growth without incurring these longer term costs.